I'm joined by my colleagues Alida de Swardt from IMG and Marthinus and Jan from OUTsurance. We wanted to today touch on a number of topics before turning to you for further questions. The first point, I guess, is a sentimental one around. You would have seen that Laurie Dippenaar retired as director of RMI yesterday, and that closes the chapter on all three founders and Pat Goss, the fourth founder, now retiring from our boards. And I think it's just opportune to thank them, Laurie specifically, but also the other three who we have thanked in the past for their immense role that they've played in the creation of our group over decades. And I guess to a certain extent, today's announcement around the listing of OUTsurance as an independent company, as well as MMH and Discovery being unbundled and going away from the mothership, so to speak, from under our umbrella, are just further testimonies of what the founders have achieved here. So I just wanted to start on that note. Secondly, the agenda for today, I'm going to hand over to Marthinus and Jan shortly to talk around the OUTsurance results, followed by Alida on IMG. I will then look at the consolidated results, as well as the ordinary and special dividend proposal that we have tabled and announced this morning. I will give an update on Project Berlin, which is the unbundling of the two counters. And then this morning, we also shared some further thoughts on RMI's future strategy. That's the lineup today. We won't take too much time, probably 30 minutes or so on the first four items, and then I'll hand over to you to pose questions, should there be any. So if we could run through the agenda, maybe note down any questions you have, and then we will field them all at the end of the call. So Marthinus, if I may hand over to you and Jan on OUTsurance. Thank you.
Thank you, Herman, and thanks everyone who dialed in this morning for the opportunity to discuss the OUTsurance results and update with you. So to start off with our growth strategy update, as a reminder, I mean, we have been following a strategy to target a wider set of products sold through a wider set of distribution channels for the last 3 years. Before that, we were mainly a call center business. Now we sell via all three channels, being digital, call center, and face-to-face. The rationale is not only to give clients channel of choice, but also to create some runway for growth and diversification. We learned over time that while most clients are quite comfortable to buy car insurance over the phone and some more simple products digitally, with your more complex products, clients prefer to have face-to-face. And that was the rationale behind this. That said, our OUTsurance personal direct business and the UE direct business is still extremely important to us. They're expected to contribute the bulk of the profits, and they have the strongest margins. As such, we are very pleased with the solid growth, unit growth for both of these business units, and also the improved premium inflation we've observed. OUTsurance Personal achieved 5.8% gross written premium growth, and if you exclude the FNB home loans book, which is currently in runoff, that growth would have been 6.6%. We still remain confident that once premium inflation has normalized completely, we can get back to the 8% premium growth for OUTsurance Personal, where we were at before COVID. UE Direct achieved a strong 11.3% gross written premium growth, and that was supported by very strong premium inflation as a result of the high natural peril claims and the reinsurance premium increases in Australia. Then if we look at our growth initiatives, OUTsurance business has lots of runway given our current market share of only around 3%, and the success that we've seen with this broker force to date. The OUTsurance brokers channel achieved 69% premium growth, and that strong growth lifted the overall OUTsurance business growth to 22.9%. OUTsurance Life has a similar consideration where we believe we have large runway as a result of our current low market share and the early success in the new channels. Especially the ShopRite channel is gaining good traction, and as we mentioned before, we believe because of the high churn in the funeral business, you must have a channel with a very low acquisition cost, and this is what ShopRite offers us. So gross written premium grew by a healthy 23.7% for OUTsurance Life. Then if we were to look at UECTP, UECTP offers us additional premium growth, but also diversification from business which is linked to catastrophes, the natural perils and the climate change. And it also offers us the opportunity to strengthen our standing in the new. Could you guys perhaps just mute while we're busy? Excellent. Okay. So we were talking about CTP. So apart from the premium growth that it offers, it also offers us the opportunity to strengthen our standing in New South Wales and South Australia, where we plan to expand in car and home insurance business. And we have already observed improved penetration in New South Wales since the launch of CTP there. The expansion to offer CTP in South Australia from 1 July 22 is therefore part of our state-based growth plan. And overall, CTP remains on track. As at the end of December 2021, we had 100,000 active policies in force after just 1 year of trading. Then to get to UEBZI, UEBZI offers us access. It's the face-to-face channel, and it offers us access to the higher end of personal lines, especially home insurance, as well as SME business. UEBZI was already up to $77 million gross written premium for the 6 months. We are also in the final stages of exercising our option to take up a further 30% in BZI over and above the 4% we are already holding, just to secure the future of the channel. And the rationale behind this face-to-face distribution is just because in the long run, with technology changes, we still believe car insurance growth will probably lag CPI inflation a little, whereas home insurance is expected to run much faster than CPI inflation because of trends like climate change, the proliferation of solar, more electronics being incorporated into houses. So while the current high natural peril claims is obviously a short-term setback, in the long run, we do see home insurance as a growth area, and we'll elaborate on that a bit more later on. Then just as a last point on this slide, to talk about our international expansion. As mentioned in our call in November, we obtained board approval for expansion to another country. Just in order not to preempt the license application, we prefer not to announce the country as yet. What we can say, it is a country with a stable regulatory regime, and one that would allow us to apply our 2 key strengths of direct distribution and scientific underwriting. The size of the plan was also chosen to allow us not to bet the farm, but still be significant enough to move the dial for the group. And the current plan is to start selling policies 18 to 24 months from now. Okay, then we can step to the next slide and just look at an overview of the key operational themes. Firstly, looking at OUTsurance, the overall theme there is one of strong growth, but lower profitability. The lower profitability is driven by the higher loss ratio, which in turn was driven by 4 things: normalization of vehicle driving patterns post-COVID, higher average vehicle claim size driven by supply chain issues, wetter weather, and higher load shedding. Now, one may ask, why did we not price more proactively? The answer is that while our pricing is very scientific, the large macro themes can only be priced for on a reactive basis. If during COVID, while vehicle loss ratios were quite low, we were to tell clients, listen, we're going to increase your premiums now, I mean, there would have been reputational risk and possible loss of market share. I mean, similarly with climate change, you can't, while your profits are quite good, raise the premiums. Once you've taken the losses, it's much easier to raise the premium, similar to the reinsurance industry on these macro trends. So what we did know is that it was going to normalize, we just didn't know when. The fact is that the normalization happened quite fast, and it was aggravated by the supply chain issues and the other factors we mentioned. But that said, we believe OUTsurance Personal navigated this better than most of our peers. We already released results, and you'll see that when you get to the segmental analysis for OUTsurance Personal. If we were to look at UE, here it was a similar story of strong growth, but even more extreme reduction in profitability on the back of the higher loss ratio. We previously flagged the higher reinsurance retention level as a potential contributing factor, and that did materialize. As a reminder, in the previous financial year, our per event retention was $10 million per event. In the current year, it is $30 million per event. We had such an event in October, and as such, on a short period like the current 6-month period, it creates a large distortion. But we've also indicated previously that we have a natural perils aggregate cover in place, and that attached at the end of January, and that affords us $70 million of cover in excess of $60 million. So that just gives a bit more context. Over and above the CAT retention level, we also had a high frequency of smaller events. And if you were to take the combined effect of these two and express it as a percentage of net earned premium, it accounts for a 10 percentage point increase in the loss ratio. Sort of 6% relating to the retention level, 4 percentage points relating to the higher frequency of small events. So put differently, if we had similar retention and catastrophe experience as the previous year, our loss ratio would have been 10 percentage points lower. As indicated, we expect the next 6 months to be better because of the reinsurance structure, and also there's obviously strong premium corrective action being taken by the entire market. We have a graph depicting also the market situation as well as this effect on the loss ratio, which we'll get to a bit later. Okay. Then OUTsurance Life, as we mentioned, we had strong new business growth. We also had a very satisfactory increase in VNB margins and embedded value. But as with most insurers, we were negatively affected by the Delta wave. But on the positive side, the fourth wave was much more moderate. So that's in a nutshell the overview of the key operational themes. I'm going to hand over to Jan to deal with some of the specific financial results.
Thank you, Marthinus. I'll start with the corporate developments that occurred over the last 6 months. The participants on the call will be well versed in the disposal of Hastings. I think it's just worth noting that disposal generated a 2.4 billion rand profit for the OUTsurance Group. That is a number that our results are normalized for. We also completed the acquisition of a 5.3% additional interest in UE during the course of October, and that has reset our interest in UE at 89.8% as at the end of December. We also have an intention to acquire a further 5.3% interest in the business over the course of the calendar year. We also, as Marthinus mentioned, completed or in the process of completing the acquisition of a 30% interest in Blue Zebra, which will take our collective interest to 34% in that business, which is a strong strategic stake for the UE Group to hold. And then we also concluded an agreement to dispose of our business interest in OUTsurance Namibia. We own a 49% interest in OUTsurance Namibia in partnership with the FirstRand Group. And the FirstRand Group has opted to acquire the business from the OUTsurance Group. And that allows us to ensure our resources are focused on the various growth initiatives underway in South Africa. I'll then move to providing participants with an overview of our consolidated results. So I'll start with the gross written premium performance for the 6 months. So here we've seen very strong net earned premium growth for the group consolidated at 11.8% and gross written premium growth of 14.3%. And contributing to that growth is OUTsurance across the personal and business segments realized 9% premium growth, and UE generated 26% premium growth in dollar terms. Annualized new business premium is a good metric to follow to understand the path of premium growth ahead. And here we've achieved record annualized new business premium growth of 17.9% for the 6 months under review. Then turning to our earnings performance, Marthinus alluded to the impact of the natural perils claims of particularly UE on the group results. And that's illustrated on the graph at the bottom left. Here it shows the impact of our retained losses, natural perils losses, as a percentage of net earned premium. And this really is the big theme and big point of context for our results for the 6 months under review, where the elevated claims ratio resulted in the drop in earnings that we are seeing. UE's claims ratio increased from 53.4% to 62%, and the OUTsurance claims ratio increased from 49.8% to 53.9%. As Marthinus mentioned, there are other factors at play in the claims ratio, such as the inflation on our repair costs, load shedding related claims in South Africa, as well as the return of vehicle claims frequencies to pre-pandemic levels. The business is undergoing a significant investment across these growth initiatives, but also infrastructural investment with regards to systems transformation, as well as regulatory reform at UE following various new components of legislation following the Royal Commission in 2018. And as a result, our expenses in absolute terms have increased over the course of the last 6 months. We've also resumed salary inflation increases following the pandemic period in 2020, where we did halt remuneration-related increases. As a result of these factors, our operating profit for the group is down by 35.3% for the 6 months, and our normalized earnings is lower by 23.3%. The differential between those two metrics is as a result of strong investment income that was generated on the group's equity portfolio over the course of the last 6 months. I'll then turn to, I think, a further point of context is the large investments that we are making in our various growth initiatives. The graph on the top left illustrates the impact of these events on expressed as a percentage of the profits of our more mature business units. And here we saw the impact at 20.2% for the 6 months under review. That is above our appetite of 10%. Importantly, that appetite is considered on a full financial year basis, but due to the lower profits emerging out of UE due to the natural events, the impact of the growth initiatives was more pronounced in the 6-month period. Our ROE at a group level generated at 27%, and that is the aggregation of the ROE of our operational business units. And if we then combine the historic investment on Hastings as well as surplus capital of the group, the overall group ROE was 23.6%. With the disposal of Hastings, we anticipate that the group ROE will trend towards the operational ROE over the next reporting periods. Our dividend is unchanged at 24.7 cents a share, which equates to a payout ratio of 85%. The reason for the unchanged dividend in the context of the 23% lower earnings result is underpinned by our confidence in the second half earnings at UE, where we do have a high degree of insulation from natural perils events due to the natural perils aggregate treaty, which will apply in the second half. The dividend also follows a special dividend that we paid in December of 82 cents a share following the disposal of Hastings. If we disaggregate the group results and look at the normalized earnings performance of the various entities in the group, OUTsurance in total, which is our short-term insurance business in South Africa, achieved an 8% lower normalized earnings result at 937 million, which is attributed to the higher claims ratio, which Marthinus also alluded to. The UE group result was down 70% due to the impact of the higher number of natural events and amplified by the impact of the increased reinsurance retention from $10 million to $30 million on large events. OUTsurance Life generated a loss of 21 million for the period. I think important context here is that the business incurred 90 million rand of mortality claims in the first half of the year. That's due to the impact of the Delta wave predominantly. And that compares to a 36 million mortality loss in the comparative period. In addition to the impact of COVID, we also are making significant investments here to establish a tied agency distribution force for OUTsurance Life, and those initiatives commenced in July. And we also continue to invest in our funeral business, which is starting to emerge out of its J-curve. Our earnings from associates, which is predominantly the earnings from Hastings, was down 27.5%, and noting here the shorter accounting period given the timing of the disposal prior to 31 December. The group's capital position remains very strong. OUTsurance is trading off a 1.7 times SCR multiple pre-dividend, and that compares against a target of 1.2. UE Group at 2.6, compared against a target of 2, and OUTsurance Life also in a very strong capital position. The group's overall SCR ratio is 2.3 times, and important here is to note that we have retained 1.7 billion rand from the disposal of Hastings, and that will be applied to acquire a further minority interest in UE, as well as to retain a significant proportion of the capital that will be required for our international expansion ambitions. Thank you, Marthinus. I'll hand back to you for the group outlook.
Thank you, Jan. Then looking at the main themes of the group outlook, firstly, rising premium inflation, because of the factors mentioned before, should continue to support strong premium growth in the medium term. Then thinking about the Ukraine conflict, that obviously brings macro uncertainty. We do have a strong balance sheet and quite conservative investments to mitigate that. We're also highlighting that UE second half earnings should be much stronger as a result of the attachment of the aggregate cover, which attached at the end of January. And that is with taking the latest floods that you might have observed in Australia into account, as we've done a lot of modelling and estimation around that. Our growth initiatives of OUTsurance Brokers, OUTsurance Life, UE CTP and UE BZI should maintain the strong premium growth momentum. And really our current focus is to translate the top line growth of these growth initiatives to bottom line growth. The high natural perils claims in Australia move the goalposts of where pricing should be, but we are catching up fast to get the home loss ratio, of which BZI carries a large weighting on track. You will also see that we included a graph in the UE section showing the profitability of the Australian industry in home insurance over the last 10 years. And we think this is very important for context. The general observations are that it is a profitable segment through the cycles, but that everyone made losses the last 2 years. But as was the case after Cyclone Yazi in 2011 and the multiple storms of 2015, there could be very profitable years to come, given the significant market correction in rates that's currently taking place. So that's some context around the BZI and the UEM loss ratio. And then also worth noting is our cost ratio have reached a turning point. As Jan mentioned, we have those investments. Some of the Royal Commission expenses, is not all of it is permanent. Some of it was once off, and also as the J curves turn. So we expect the full year cost ratio to be lower than the half year cost ratio. The out business brokers remain on track for break even in the third quarter of calendar 2023, and its monthly loss profile is expected to continue to improve with scale and maturing loss ratios. Then as a last point, Jan alluded to the system modernization and the service digitalization. That continues to ensure we maintain our competitive advantage in the quantity as well as the quality of our data, and as well in our cost ratios. So those of you who are clients, I would like to invite you to have a look at the Help It Out section in our app to see some of the latest exciting features there. So that's the outlook in a nutshell. Thanks. Over to you, Jan. You're done.
Thank you. Thanks, Marthinus. Thank you, Jan. Next up, we have RMI Investment Managers, Alida.
Thank you. Morning, everyone. I thought we could start with a quick reminder of the RMI IMG portfolio, and just to remind you that we hold minority equity stakes in the various investment managers that we've got on screen here, and that is alongside our other co-shareholders in IMG being Momentum Metropolitan and Royal Bafokeng Holdings. From a portfolio point of view, our portfolio achieved quite healthy growth in AUM over the last 12 months to the end of December, and we reached a collective 209 billion of AUM by December, which was a pleasing result. Of this, 35% of the growth over the last 12 months was attributable to new client net inflows, and that resulted in our overall exposure to the retail segment being 23%, by the end of December. That was always a strategic target for us to grow the retail exposure within our portfolio, which historically have been dominantly institutional. In terms of our largest asset class exposure, you'll see that as of December, listed equity remains the biggest exposure, but we are pleased with the progress our affiliates have made in terms of growing their share of the multi-asset categories, which we know in South Africa is the lion's share of the savings market. From a normalized earnings point of view, you'll recall that our portfolio generated significant performance fees during the previous financial year. And in terms of the current period, 6 months to December, we're pleased to report that our affiliates have continued good investment performance. We've seen the good growth in AUM, resulting in our financial performance being ahead of expectations. That said, we do not expect the same level of performance fees from the previous financial period to be reported during the current 12 months. Lastly, also just wanted to highlight that IMG, in IMG, we recognize the absolute importance that transformation and diversity plays within the investment management industry. And alongside our empowerment partner, Royal Bafokeng Holdings, we put a lot of focus and emphasis in terms of improving the transformation and diversity credentials across our affiliates. And we've just given you here a snapshot of some of the progress that we've made in improving our BEE credentials, but as well as our staff the staff transformation, both in terms of gender and in terms of Black employees across our affiliates. That's it from me.
Thanks, Alida. We wanted to, as a third topic today, wanted to give you an overall view of the RMI results. I'm not going to go through the detailed numbers. For us, you could imagine that it's quite an accounting nightmare to think about all these numbers, because we effectively had Hastings, Discovery and Momentum becoming discontinued operations on the 8th of December, which was the date that we received the sale proceeds from Hastings, and also the date that the unbundling then from an accounting point of view became very probable. So unfortunately you find quite a complicated set of analysis. The way we think about it is to stand back, exclude Hastings. I guess that's out of the portfolio now, and we have achieved a great profit on that sale. And we were able to repay all the debt in the group, plus then have the two sets of surplus cash available, just over 2 billion at OUTsurance, and in addition to the 2 billion of special dividend to you today, we have about 850 of cash on balance sheet at RMI. The second set of assets here that we think about in a commercial way, we look at the COVID recovery and the recovery that we've seen at Discovery and Momentum Metropolitan. Those numbers are around the 26 and the 51% normalized increase that you as investors across the market would know and have analyzed after the results from Discovery and Momentum. So for us, it's probably slightly bittersweet to see our two life companies exit the group. They have achieved good results, and I think it's also probably the right timing and the timing that we were waiting for to have the COVID effect, hopefully mostly out of the life insurance earnings. They both feel that they are well capitalized for any potential further waves. So we think of our results in a commercial way. Marthinus and Jan explained the first 6 months, which were probably slightly harder than you expected. That's natural perils. It's the fact that it's seasonal, plus the fact that we have now gone through most of the reinsurance to get to our aggregate level. So we're very pleased that should bode very well for the next 6 months. Discovery Metropolitan we've spoken about, and then we will now also start seeing the cost decrease, but I'll get to that in the next topic. The dividend proposal that we announced today, you would see that the interim dividend is an increase, as an inflationary increase on the normal interim dividend of around 23.5 cents, and then we also declaring a special dividend today of just over 2 billion. At this point, while we're talking about distributions, I just want to spend 2 minutes on the unbundling. You would have seen the narrative in the results that it is a matter of days for us to announce the terms and the detail around those two unbundlings, MMH and Discovery. Everything is on track. We are just looking at the last regulatory approvals and just getting all the detailed numbers sorted out. But that is imminent. It will be announced very soon, as in next week, we hope. The next topic then, I guess, is a logical step when you look at the first step being the unbundling of the two listed entities, which immediately unlocked quite a bit of value last year, with the share price going from around 30 to mid-40s. The second step in that process was then the sale of Hastings and the elimination of a rights offer and the repayment of debt. That added quite a bit of value to the group. And as we said in December, we were then faced with a natural fork in the road, where we had to compare two things. People ask a lot of questions around the one part, which is the prospect of diversifying into other local champions. You'd remember that we have spoken to the market quite extensively about the importance of picking the right country to go in to be a short-term insurer if your style is similar to what we'd like to utilize. We did extensive work on a country analysis, followed by extensive work on possible targets. And we concluded that on the one side of the equation, we did not see a very attractive asset in terms of quality of asset, price, or availability. As you know, those three things, plus some other factors, all need to work together to make for an attractive acquisition or investment. And although we believe in that diversified network of collaborating and non-competing local champions, we had to compare it with what we've achieved as far as RMI on a standalone basis is concerned. And that's a great asset in OUTsurance, cash yielding, growing. We were very happy with what you would have seen on the premium growth side. A debt-free business with growth initiatives, both in this country as well as in others. And I think when you weighed up the possible risk of potentially diversifying again into other assets, and you compare that to the quality of OUTsurance and that we have, we reached the conclusion that we wanted to end RMI's active investment strategy. There's no immediate impact on US shareholders. You retain exactly the same assets today, tomorrow, and in a year's time. What would, of course, change is that over time, the management responsibility for the group will swap or switch over to Marthinus and his team at OUTsurance. And he would be working with what we think will be a combined board of RMI and OUTsurance. These are all still a lot of deliberations we need to go through, but I just wanted to leave you with the comfort that the set of shareholders or the group of shareholders above RMI will stay exactly the same, depending on your actions, of course. And what you may see is that RMI's name will change to OUTsurance Holdings. I know it's already taken, but OUTsurance Holdings at the top. With the management team assuming responsibility as they have for the group and for the assets, and then with the combined group combined board, who are of course very excited to see how OUTsurance would be performing on its own. It's not completely on its own, of course, because we have the business that Alida described, as well as the Alpha Code portfolio. These two businesses will continue exactly as they are. It's probably a good inflection point to think about whether we have the right ownership and other structures in these two assets. But the default and what we expect to happen is that Marthinus and his team and the board will become very responsible owners of these two assets if there are not other alternatives that present themselves. We're not concerned. We're not putting up the for sale sign on those assets. We know that there are probably a couple of calls waiting for us as we leave this room. But as you would have seen with our other corporate actions, we are quite deliberate and we believe that time is our biggest asset when it comes to corporate structuring. So yes, and I guess there will probably be a question. The other immediate thing that will happen is that there will be cost reductions at RMI, and we have already started that. The cost base needs to be commensurate with the decrease in investment activity. So don't worry, we are starting to have salary reductions, and we'll continue to do that until we exit. On the exit, to the extent you may be interested in that, and some of you are also RMH shareholders, my management team are committed to the end of the year to look after both businesses. And for the time being, at least, I'll continue as OUTsurance chairman as well. But nothing will change. The final chapter is written, but the book's not printed. So please bear with us. And I think that, Kiara, if I'm right, is the last bit on the formal agenda. So we open for questions. Thank you very much.
And the first question is from Jared as regards to what is the normalized group SCR ratio or SCR that OUTsurance can operate at. Jared, we do have a target SCR ratio for OUTsurance, which is, I guess, a minimum of 1.4. And I guess over time, we will operate below the 2x multiple through the cycle. I think it's just worth noting the reasons why we are currently retaining capital at the center, given our expansionary program in the business.
Thank you.
We have a hand up from Mike Christelis.
Michael, please go ahead. I hope we can hear you. Otherwise, we'll just get you to type. Oh,
Good morning, guys. Can you hear me?
Yes.
Awesome. Well, Herman, nice of you to write the final chapter of the book. It was a pleasurable read. I'm looking forward to what comes next in the sequel. Just a couple of questions, maybe, if I can. Firstly, from an RMI perspective, are you still committed to participating in Discovery's capital raise that they are still planning to do? And your thoughts around timing on that, given the sort of process of events that needs to take place. Then secondly, moving on to OUTsurance. I mean, previously, Jan, you've run at a very high dividend payout ratio. Can you talk a bit about how you envisage the dividend policy to play out from an OUTsurance perspective once all is said and done, and we're in a listed OUTsurance environment? And then also, if you can just sort of give us an update. I think Marthinus mentioned you might be able to update us a little bit on some of the modelling you've done on the flood costs in Australia in the second half so far. Thanks, guys.
Thanks, Mike. We are still committed to any possible capital raise at Discovery. I guess time may not be our friend if they wanted to contemplate something like that. And the next milestone for us, as I said, is within a matter of days, announce the exact number of MMH and Discovery shares that shareholders will get as a ratio of current holding. Once we announce that ratio, and we lead into the last day to register and the final distribution, we cannot further participate, and we've also alerted Discovery to the fact that we would obviously not like them to participate or launch any rights offer or any capital raise of whatever nature in that period of time. As you can imagine, we can't participate and will be diluted again under the 25% minimum stake. So we've been speaking constantly to them. I can't comment on the likelihood or requirement for capital raise, but to the extent that Adrian and Dion are still interested to do so, you can see how we are going to go into a short period where it's not possible. Well, it would be possible, but highly inconvenient for our process, because we would have to start again and publish, the final numbers for US shareholders. But we are fully aligned and in communication with Discovery.
Michael, with regards to the dividend approach, our philosophy is anticipated to remain consistent. I mean, we have an approach where we declare any excess earnings that we don't need to support organic growth initiatives in the business. So in periods as we are currently, where we are investing a fair bit in the business, that could imply periods of lower dividend payout ratios, and the opposite would also apply. In terms of funding any major strategies, our preference remains to fund those from retained earnings as far as possible. And given the positive effect of the Hastings disposal on surplus capital, we also think that any major strategic expansion, such as international, will have a muted impact on our dividends going forward, as those strategy will be funded on an incremental basis. I think an important point of context in your question, when you consider our historic dividend payout ratio, is also many of these growth initiatives will not operate at the same margins that our two personalized operations operate necessarily. Those would be lower margin businesses. And over time, that will affect the path of our dividend payout ratio compared to our historic performance.
I'll take a couple of other questions. The special dividend, Warren, that you refer to, that RMI would have received from OUTsurance. Jan can maybe just help me with the specific timing, but the 82 cents that we received as RMI from OUTsurance is exactly what we've been using as part of the special dividend to you. So Skalk, I see, is on the line. But all of that, that what you've seen today, after all of this, we will have, as I mentioned earlier, between 800 and 850 of cash at center at RMI, the entity. Galt, would you like to comment further on that, please?
Warren, so what you'll see on the group cash flow statement is the 14.6 billion total proceeds that the group received on the sale of Hastings. The special dividend from out back to RMI is just moving cash around in the on balance sheet group bank accounts. And then RMI, basically, everything worked out very nicely in terms of having sufficient cash to pay back all debt, and OUTsurance being afforded the situation where they could hold back sufficient cash, as Jan mentioned, for the international expansion, and then buying out minorities in UE and so on. So the total sum worked out very nicely, and we used basically all the cash we received from OUTsurance as the final part of repayment of debt.
Herman, there was just the last part of Michael's question around the modeling. So, Michael, I mean, there's obviously still a lot of uncertainty around that event because there's demand surge and reporting delays and issues around that. But currently, the industry estimate is just over $2 billion, and our own internal estimate is just over 80. But as we say, there's still some uncertainty. Another point of uncertainty is just how many events will it be classified as. There's always push from the reinsurance market to classify it as more events, and push from our side or the direct industry as less. The impact of that would obviously, because of the aggregate cover, our event retention is only $2 million now, not 30 like it was the previous 6 months. So if it were to be classified as 3 events, our retention would be 6 mil. If it's 1 event, it's 2 mil. So just keep that for context, but there's still large uncertainty as to the final amounts. But we certainly modeled it, and we think the risk of using all our aggregate cover is extremely remote, because the size of the classifications also points to a bigger second one if it's classified as 2, which will mean that a much bigger portion of it will go into the catastrophe excess of loss as opposed to the ag. So we're quite comfortable that we're still well positioned with regards to the reinsurance situation.
Thanks, Marthinus. A question from Leonard on the tax liability regarding the unbundling. There, you would recall that we mentioned that it's obviously all a function of the percentage of disqualified shareholders in our base, of which there's about 7%. And then the other function, or the other factor, is the relative or the market price of the shares that are being distributed. In the case of MMH, there is no CGT payable. In the case of Discovery, that price has moved quite a bit since the original unbundling announcement. And as things stand, Leonard, there's about 40 million rand of CGT payable on the Discovery part of the unbundling. Roger, your question on will there be further special dividends post the disposal of RMI Asset Management and Alpha Code? I would say there is no specific or pending disposal or disposals of those 2 assets. I guess my words were, there's not a for sale sign on these per se, but we will continue to consider approaches should they come. But yes, if there are disposals, we will be distributing such proceeds to shareholders. But my sense is that'll be a question to Marthinus. It will be past my time. Marthinus, do you agree? Then
There's a hand up from Jacques Conradi.
Okay, so I'm just Roger had a couple of questions. He has a question on the OUTsurance business and life profitability, which I'll hand over to OUTsurance in a second. Roger, your question, management valuation of non-core assets of 1.9 billion. The answer has to be yes, because we've been fairly conservative. You would know that for a number of years we were at cost for those assets. Recently, there have been very positive flows into the asset management side and better performance generally. Businesses also becoming profitable through the scale curve. And then on the Alpha Code side, we did a transaction where KKR came in as an investor in Intersect. So we had a conversation with the auditors. I think our overall approach is still a very conservative one. We apply all sorts of liquidity and other discounts to it, and this is also verified and audited by our auditors. So with that in mind, I have to say that it is a realizable, or at least a realistic value. Whether that's realizable is anybody's guess, but we're very comfortable with that as a starting valuation. Alida, do you want to add to that?
No, I think you covered it well.
Okay, thank you. And then
the question is then extended on the confidence we have in the profitability of OUTsurance business and OUTsurance Life. Roger, we previously guided that we believe we can achieve monthly profitability by mid-2023 on our specific investment in the OUTsurance brokers tied agency channel. And that would still be our target and expectation at this point in time. I guess as a growing business, we do have the debates internally on the trade-offs between further investment, given our traction, and also bringing the business towards break even. But as Marthinus alluded to earlier in our group outlook, I think we do have the discipline to bring the business to monthly profitability in 2023.
Maybe on that topic, when analysts look at the business OUTsurance year on year for the 6 months, it must be borne in mind that our COVID release took place in the prior year. So that pulled down the previous year loss ratio significantly. So it makes the jump from 2020 to 2021 seem much larger than what it is. Over that period also, the broker side grew quite fast, and that is running at a higher loss ratio. So you have this mix change towards the higher loss ratio part. We also flagged previously that when you grow fast, you have more first year business, which naturally runs at a higher loss ratio. So that is also a factor in that. And maybe a last thing, I mean, in December, we had in that broker space 4 very large claims totaling around 40 million. Now, on a relatively small book, that also elevates the loss ratio quite a bit. So overall, we're still comfortable that we can move towards the target. And the guidance we've previously given on that broker book is once fully up to scale and the loss ratio matured, we do believe we can achieve a 15% more underwriting margin on the OUTsurance broker business. So hopefully that just gives a bit of extra context on the apparent big jump in the loss ratio from year to year. Thanks, Jan.
Thank you.
The life, with regards to OUTsurance Life, Roger, there's sort of, I guess, 3 components here. So first of all, the funeral piece has got 2 components. So there's a direct angle to funeral distribution, and then there's the ShopRite JV. I think it's a good outcome for us that the ShopRite JV has turned to be a profitable venture and also a very fast-growing venture within OUTsurance Life. The direct funeral operation is still stepping through a J-curve. And again, there we believe we can bring that business to monthly profitability over the next 12 to 18 months. The face-to-face investment is building out a tied agency investment. In the context of OUTsurance Life, this is a big investment, and we only just started with that. But again, similar to our business OUTsurance expansion, this is a strategy that will be incrementally validated as we proceed. And the generation of positive EV earnings and positive VNB margins will be the ultimate judge of how we proceed through that strategy. The underwritten life business, which is the mature part of OUTsurance Life, if you ignore the effects of COVID, is an inherently profitable product within the OUTsurance stable, and that will predominantly also be the core component of our earnings for OUTsurance Life in the near future.
Yaro, did you mention that there was another question?
A hand from Jacques Conradi.
Jacques, please go ahead.
Hi, morning, everyone. Just from our side, I mean, congrats on good numbers and thanks. I think it's a very shareholder-friendly restructure. Appreciate that from a shareholder side. Maybe just one detailed question, Herman. So I think you report about 3.5 billion of net assets at the RMI level at December, and I think it's about 1 billion that came in with the OUTsurance and the Momentum ordinary divs. So deducting what you're paying out, I've got about almost, let's say, 2 billion or so of net assets left. And I think you said about 800 million of that is cash. So maybe some indication as to the time, I mean, to get those assets liquid, and would the intention be in time as they become liquid to be able to pay that out to shareholders?
Yep. I'm going to ask Scott to chip in here, but yes, there are some near cash and other working capital facilities we've provided. You'd remember there was some management incentive at MMH, etc. All of that has started, or some of it has started to come back. So I think the crisp answer is yes. As they monetize, we will put them into Jan's kitty, and the new management team will decide what to do it with. But yeah, they've been generally very focused on cash distribution, of course. So yes. Kalk,
thank you, Herman. Nothing to add from my side, just to sort of say, I mean, there's a fixed term to the, let's call it the near cash item. So, I mean, there is a time when it will come in cash. Yeah. So it is, let's call it liquid in that respect, but it's got some time to run before we physically receive it in cash.
Okay, perfect. Thank you.
If there's nothing else, we have 3 minutes to the 3 minutes to the hour. So I would like to thank everybody for your attendance. We are going on the road today, and then we're also at a couple of the investor conferences in the next number of weeks. So we hope to see you all there. And thanks for your attendance today.